You know, the US tax system, it can feel like this impossible maze, right? But what if it wasn't? What if it was really just a simple journey with a clear roadmap? Well, that's exactly what we're going to do. Over the next few minutes, we're walking that path together, step by step, to completely demystify the whole thing. It's a simple idea, right? You earn money, you pay taxes. But that whole journey in between, with all the exclusions and deductions, it can feel like a total black box. By the time we're done here, you're going to have the map. You'll understand exactly how that journey works. Okay, so let's get into it. Welcome to the Tax Formula Roadmap. I want you to think of this as a super logical journey. It shows exactly how all your income gets filtered down, step by step, to the final amount that you're actually taxed on. For all the complicated forms and rules, the core calculation is surprisingly simple. It's really just a process of subtraction. You start with everything you earned, and then you just systematically remove the things the tax code lets you. You're basically chiseling away at that big number to get to a much smaller final one. Okay, so check this out. Here's the entire journey right here on one slide. We start at the top with gross income. Then we subtract our first set of deductions, we'll get to those, to hit a really critical midpoint, your adjusted gross income, or AGI. From there, we subtract a second set of deductions to land at our final destination, taxable income. And that is the number that ultimately decides your tax bill. All right, so let's start right at the beginning. Before we can subtract anything, we have to know what our starting point is. What does the IRS even consider income? And let me tell you, the IRS defines this very broadly. It is way more than just your salary. We're talking tips, game show prizes, and believe it or not, yes, even illegal income. To them, the source really doesn't matter. If you got it, if it was an economic gain, it's part of that big starting number. But, and this is important, here's our first filter. Not every single dollar that lands in your bank account is considered gross income. The tax code specifically excludes certain types of money right from the get-go. So, what are we talking about? Well, for example, if someone gives you a gift, or you get an inheritance, or you receive child support payments, that money is not considered taxable income. It's completely excluded. This is the very first step in filtering down that big number we started with. And this brings us to a really key concept called the realization principle. Okay, imagine this. You own a stock, or maybe your house, and its value doubles. Awesome, right? You're wealthier on paper. But you don't actually owe any tax on that gain until you sell it. You have to realize the income by actually making a transaction for it to count. Okay, so we figured out our starting point. Gross income. Now for the fun part, making that number smaller. Let's move on to the next stage of our roadmap and talk about deductions. Okay, this right here is an absolutely crucial distinction. There are two main types of deductions, and they're separated by that big dividing line, your AGI. We call them above the line and below the line. The above the line ones, like student loan interest, you subtract from your gross income to get to your AGI. The below the line ones, those come after you've calculated AGI. And that's why your AGI is so important. It's not just some random midpoint on the roadmap. It's the number that determines if you even qualify for a ton of other tax breaks, like certain education credits, or if you can deduct your IRA contributions. So a huge goal in tax planning is to get that AGI number as low as you legally can. All right, so once you've got your AGI calculated, you come to a major fork in the road. This is the big below-the-line decision for most people. You have a choice. Take the standard deduction or itemize. Itemizing just means you add up a bunch of specific expenses, things like mortgage interest, state taxes you paid, or big charitable donations. It's simple, really. You just pick whichever path gives you the bigger number. Now, for most people, the standard deduction is just the easier path. It's a fixed amount, no questions asked, that you can just subtract from your AGI. And as you can see, the amount just depends on your filing status. So for 2024, a single person gets to deduct $14,600, while a married couple filing together gets exactly double that, $29,200. And speaking of filing status, that brings us perfectly to the next piece of our puzzle, your personal situation. Like whether you're married, who you support, it has a huge impact on how your taxes get calculated. This is probably one of the most common questions people have about taxes. Claiming a dependent can open the door to some really valuable tax credits, but you have to follow the rules. And they're super specific. The tax code actually splits dependents into two totally different categories. So let's break this down, because it can get a little tricky. First, you have a qualifying child. To claim them, they have to pass 4 tests: relationship, residence, age, and support. That support test is key. It means they can't be paying for more than half of their own stuff. Then you have a qualifying relative, which is a totally different set of rules. There's no age limit, but they can't earn much money on their own. There's a strict income cap. And see how the support test is flipped? For a qualifying relative, you have to be the one providing more than half of their total support. So why do we jump through all these hoops? Why all these tests? Because of this number, $2,000. For every single qualifying child under 17 you claim, you can get a tax credit worth up to $2,000. That is a huge, huge deal. And hey, it doesn't even stop there. For any other dependents who don't quite fit the qualifying child rules, maybe it's an elderly parent you support or a college student who's over the age limit, there's another credit, a $500 credit available for them too. All right, we've covered a lot of ground. We've talked income, exclusions, deductions. We're officially at the end of our roadmap. So let's bring all these pieces together and see how we finally get to the bottom line. Okay, so here's the bottom line, literally. After you start with your gross income and you subtract all your deductions, both above and below the line, you land on this one number, taxable income. This is the bottom of the funnel. This is the only number that the tax brackets and the tax rates actually care about. And this brings us to one of the most important things to understand in all of taxes, the difference between deductions and credits. A deduction is good. It lowers your taxable income. But a credit is way more powerful. It reduces your final tax bill dollar for dollar. Think about it. A $2,000 deduction might save you, a few $100 depending on your tax bracket. But a $2,000 credit, that saves you the full $2,000, period. So let's put it all together and cross the finish line. You take your taxable income and apply the tax rates to it to figure out your initial tax. From that number, you subtract those amazing tax credits we talked about. Then you subtract all the money you've already paid throughout the year from your paychecks. That's your withholding. And what's left? That's either the refund you get back or the final amount you still have to pay. And there you have it. That's the roadmap. See, it's not some mysterious black box. It's just a logical journey of starting big and then filtering and subtracting your way down. The most important takeaway here is that every single step on this path, from exclusions to deductions to credits, is an opportunity. Now that you have the map and you understand the journey, the real question is, where will you let it take you? How are you going to use it to navigate your own financial future?